If a guy rushed into a coin shop and said, I want to buy gold too, and he had 500 or 1,000 bucks, they would drop 1 or 2 coins in his hand. And that's it. You go, oh, is that all I can get? How much is the silver? Well, the silver, you can get 40 of those for one of these. Oh, well, I'll take the silver. And so that is the reason for this spike down, which is silver going up faster than gold, measured in dollars. And this isn't over until it's over. Now, we had the big spectacular price run up in January of silver, and it hit 122 bucks an ounce. And I've been saying for years, silver is destined for triple digits. It will be in the triple digits, and it's all just a matter of the underlying fundamentals. Now, Jeff Christian, in a panel that we were on, responded to that as triple-digit silver is Coke-induced nonsense. Well, I've already been proven right, but for a short period of time, before the end of this year, I believe that we are going to be back up in the triple digits in silver. This ratio will start falling again, and we are destined for something like this. So I believe the big opportunity, however, it's a lot more volatile, is in silver. A lot of people think that, gold was 250 bucks an ounce back in 1999, 2001, and now it's $5,000 an ounce. Is its bull market over? Is it too late to get in? It's the safe haven investment for the past, ever since gold and silver became money about 2,500 years ago. And by the way, everything else is national fiat currency. There's a big difference, and everybody needs to learn the difference and then use the proper terminology.
What if I told you the biggest opportunity in precious metals isn't gold, but silver? Imagine this. You walk into a coin shop with $1,000. You ask for gold and walk out with just 1 coin. But with silver, you could walk out with 40 pieces. That simple shift in behavior is exactly what could trigger the next explosive move in the market. And according to Mike Maloney, this isn't over yet.
It's very important that we understand. Aristotle was the very first person to define the key attributes that something has to have to be considered money. It's got to be a unit of account, a medium of exchange, but most of all, a store of value. There is no national fiat currency that qualifies as money because the math behind their very creation, the way they are engineered, absolutely guarantees that they cannot store value. And if they start to store value over a period of time, they go into a deflationary implosion, which was beginning to happen during the Great Depression. That's the only real time that the dollar gained in purchasing power. When you see like the dollar index, that's the dollar compared to all these other fiat currencies that are also falling. Everybody's falling. Gold is the airplane that they jumped out of. And so gold is the safe haven investment where people run to during times of political upheaval, war. You saw what happened right after the pandemic, for instance. So anytime people have anxiety, they rush back to the precious metals. Silver is very undervalued compared to gold, but it's not over until it's over. Now, this is a picture of the Dow Gold ratio. I like to use the Dow Gold ratio versus the S&P 500. When I was a kid, people didn't even know what the S&P was. The news media, everybody referred to the Dow always. The Dow Jones Industrials have sort of taken a back seat for the past, during this century to the S&P 500. But the Dow, when you divide it by gold, it reads in whole numbers because the points on the Dow are a lot higher. When you divide the S&P, you get these ratios of 0.0 something, and people just don't think that way. So anyway, what you see here is this goes back to 1968. And in 1971, gold became free trading and took off and went from 35 bucks up to just a whisker away from 200 bucks. While the Dow had bumped its head on 1,000 points and gone sideways for 16 years with one major pullback happening in 74. So when you divide these two, you're showing the balance, whether one is in a bubble or undervalued. And what you see here is that in the 70s, gold became free trading and started to take off like a rocket. And then gold is going up, and the Dow also fell by almost 50% during the 74 bull market. And then the Dow bottomed and gold peaked. Gold was at about just a whisker away from $200, and then fell all the way to 103. That's the reason this ratio rises. And then the Dow was rising, gold was falling. And then here, the Dow goes sideways. This is all just gold rising while the Dow is bumping along sideways at 1,000 points, basically. And it went to an intraday ratio of 1-to-1. There was a day in January 1980 where gold hit $873 and the Dow was at 873 points. So this is just showing the economic balance between the two. And then we went into the greatest stock market bull in history, and the Dow went from 1,000 to 10,000, while gold was in a 20-year bear market going from 850 down to 250. So that's the reason this ratio rises. Gold extremely undervalued here. Stock market extremely overvalued in the NASDAQ bubble. The bubble pops. We've gone up and down, but what's interesting, look at the cycle here. You've got this one big move down, a retracement up, and then a big move down. Here, you've got this one big move down, a retracement up, and we're beginning. I believe that we are just beginning this, and we are destined for something, under this ratio of 5. I think you may see this go to a ratio of 0.5 instead of 1. In other words, the price of gold will be double the points of the Dow one day. That's within the realm of possibilities because it's been more out of whack than at any time in history when it goes back into balance. And so for that to happen, either the Dow has to fall dramatically, gold has to rise dramatically, or both can happen simultaneously, and it doesn't have to be as dramatic a move for either one of them. The gold-silver ratio, these things have to resolve. For this bull market to be over, for it to be too late to make the big gains on gold and silver, these things have to resolve. Here we've got the price of gold divided by the price of silver, so the gold-silver ratio. And when it's up near the top, silver is way undervalued compared to gold. And I need to point out, we're at 60.41. How often has it been 60 or above in the past 2,500 years? Well, this can actually be measured. There's some years here going back to the late 80s. And then there are some years in the 30s. But it isn't even like 1% of the time that gold and silver have been money. We have been, for this entire century, we've been in this incredibly rare event and rare opportunity to purchase silver when it is so incredibly undervalued to gold. Now, it takes I discovered all this. I started tracking all of this back in the early 2000s. And I started buying gold when it was, the spot price was $315 when I first bought gold back in October 2002. And then I discovered how undervalued silver was in early 2003. And I started buying silver when it was below $4.40. It was $4.37 or something like that, the spot price. It was below $4.40. And I've been accumulating ever since. But like I said, these things aren't over until they're over. Now, the reason I drew this purple rectangle here is back in the 70s when gold became free trading, August 15th of 1971. So that's right up in here. Silver was going up and down and so on. It was already freely traded. So that's the reason for this bouncing around when gold was actually fixed. But then gold became freely traded as well. And during the 70s, what the markets thought was sort of fair value, a fair balance between gold and silver, is that about 30 to 40 ounces of silver should be required to equal the same value as 1 ounce of gold, the same price, not value. There's a big difference, actually, and I've been teaching that for many, many years. We'll get to that in a different video. But look at where we've been since 1990. Silver, there are these rare instances where it was hitting 100. Now, it's only done that. Anything over like 90 can be measured in months over the past 2,500 years. And during the COVID crash, I was able to significantly increase my position at about 110 to 1. So when it went down to 55, I could have sold the silver that I had accumulated here and purchased twice as much gold than I paid for, basically. I do believe that you are going to see this drop below 20 one day. It is probably on its way down to like 10. I don't know.
Let's break down what's really happening. During times of financial panic, people rush into gold first. But as prices rise, gold becomes unaffordable for the average investor. That's when demand shifts massively into silver. And because silver is a much smaller market, that surge in demand can send prices skyrocketing much faster than gold. That's exactly why silver often outperforms in the late stages of a bull market. Now here's where it gets interesting. Maloney has long predicted that silver would hit triple digits. And even after skepticism from analysts like Jeff Christian, he believes this move is far from over. Why? Because the fundamentals are stronger than ever. First, silver is historically undervalued compared to gold. The gold-to-silver ratio is still extremely high, meaning silver is cheap relative to gold by historical standards. Second, we're facing a structural supply deficit. We are consuming more silver every year than we produce. Above-ground stockpiles are shrinking, and industrial demand keeps rising. This is something we've never seen before at this scale. Now zoom out. Gold has always been the ultimate safe haven, a store of value for over 2,500 years. Fiat currencies, on the other hand, are designed to lose value over time. That's why during crises, wars, recessions, economic instability, money flows back into gold. But silver? Silver is where the real leverage is. Historically, when the gold-to-silver ratio compresses, silver doesn't just rise, it explodes. In past cycles, that ratio has dropped from extreme highs down to 30, 20 even lower. And if that happens again, silver could massively outperform gold. Add to that the possibility of a major reset in financial markets, where gold rises, stocks fall, or both. And you're looking at a powerful setup for precious metals. Bottom line, gold protects your wealth, but silver could multiply it.
We've never been in this position before, where silver, the above-ground stockpiles, are so incredibly dear. They are very rare. They're running out. We use more every year than we produce. And there's something big that I'll show you in a little while that is a big difference between this bull market of the 70s, where it hit 14 to 1. So it only took 14 ounces of silver to buy an ounce of gold. I think we're going to go to maybe 10, but I think 20 is absolutely in the cards because, during the 70s, the U.S. had the world's largest stockpile of silver by multiples, and we didn't have these structural deficits that we have today. We had the U.S. dollar had only been a fiat currency for 8.5 years. Now, a lot of people will say, oh, yeah, that's when the Hunt brothers were trying to corner the market. I interviewed Jeff Christian of CPM Group years ago. This was, 2004 or 5. And I asked him about the Hunt brothers because I had a theory that the Hunt brothers were actually used as scapegoats to cap the price of gold, not silver. They had a very, very concentrated position in silver. Silver is a tiny market, sometimes 1/300th the size of the gold market. Because of that concentrated position, they were able to manipulate the commodities exchange, putting in position limits, raising margin requirements, position limits, and then finally, when they couldn't stop silver's rise, they put in liquidation orders only, where you could only close an old COMEX contract. You couldn't open up a new one. That means when you say there can only be sellers, there can be no buyers in this market until this rule is lifted. It's a rule that says basically the price can only go down. That is the rule. And they did that, and the gold traders and the silver traders were in pits on the floor together. If you don't think when they did liquidation orders only to silver, if you don't think that news got out to the gold pit right away when people were taking a restroom break or eating lunch, and then there's a lot of people, traders, that trade both. And so it's not a coincidence that gold and silver peaked on the same day in 1980. When they capped the price of silver, the gold traders are going, oh my God, we're next. It's time to sell. So that was my theory. When I asked Jeff Christian about whether he thought the Hunt brothers were responsible for driving the price of silver up to $50, it was actually $52.50 intraday in 1980, he said that he thought that they added 50 to 75 cents at the most to the price, that this was actually the public changing their preference. And that was my theory. In 1980, the average income was just below $10,000 annually. And so a guy goes to the bank and withdraws $500 or $1,000, and that may have been the majority of his savings at the time, and rushes into a coin shop and says, I want to buy gold too. And this is while the lines at coin shops in January 1980 in the United States and in Europe, they were being compared to the lines of Star Wars and Apocalypse Now. I mean, these lines went out the front door and wrapped around the block. It was a panic because the dollar actually came very, very close to failing. The Hunt brothers were used as a scapegoat to save the dollar by capping the price of gold. If a guy rushed into a coin shop and said, I want to buy gold too, and he had $500 or $1,000, they would drop 1 or 2 coins in his hand, and that's it. You go, oh, is that all I can get? How much is the silver? Well, the silver, you can get 40 of those for one of these. Oh, well, I'll take the silver. And so that is the reason for this spike down, which is silver going up faster than gold measured in dollars. And this isn't over until it's over. Now, we had the big spectacular price run up in January of silver, and it hit $122 an ounce. And I've been saying for years, silver is destined for triple digits. It will be in the triple digits, and it's all just a matter of the underlying fundamentals. Now, Jeff Christian, in a panel that we were on, responded to that as triple-digit silver is Coke-induced nonsense. Well, I've already been proven right, but for a short period of time, before the end of this year, I believe that we are going to be back up in the triple digits in silver. This ratio will start falling again, and we are destined for something like this. So I believe the big opportunity, however, it's a lot more volatile, is in silver.
So the real question is this just another dip or the opportunity of the decade? Because if history repeats, the biggest gains happen before the crowd fully wakes up. If you want more no-hype insights on gold, silver, and the global financial system, hit subscribe. Because when this move really starts, you won't have time to react.